This is Tom Asprey with the Viper Report Market Wrap video for the week ending December 19th. Bull for the holidays. It appears that some are already writing off the hopes for a Santa Claus rally, but we're getting with that window is narrowing, but the evidence still favors the upside. Let's look at some charts. For the week, it was a mixed bag. Dow was down 0.7. NASDAQ 100 just was beat out by gold. It was up 0.6. Composite was down. S&P was just barely higher. Transports have been really strong, which is typically a good sign for the economy, up 0.31%. Gold up almost a full percent. And the Russell, which had been having a nice rebound, was still down on the week. If we look at the year-to-date numbers, you can see that unless we tank in the next couple of weeks, this is going to be a year where money managers will want to say they were long stocks, particularly based on the 16% gain so far in the S&P 500, NASDAQ above 20. Gold has been the star performer, of course, but the Russell has come along nicely. So what did I see at the end of the trading on Friday? At the start of last week, we were in the quandary we've been for a couple of weeks. Weekly AD numbers were pointing higher, whereas the daily were fluctuating between positive and negative, even though the New York Composite and the S&P 500 AD had broken out to new highs. Action Monday through Wednesday really didn't help resolve that. Then Thursday, sharply higher open and closing with nice gains, up 59. I think we were up over 80, during the day. If we look at an intraday chart here, you can see that we kind of stalled up here, around that 68.37, to 68.56 area. And in the last hour or two, the advanced decline numbers, which had been better than 2-to-1 positive, closed just slightly positive. So if we'd seen much stronger numbers, that would have given me great confidence for a Santa Claus rally. Let's look at some individual charts. If we look at the composite weekly, we can see that it was down slightly, 0.37. Volume did pick up. Back in history, you can show that, everything broke out to the upside in May, signaling that the correction was definitely over. Most of our long positions were established ahead of that time. New highs in the NYSE AD, and they're close to new highs now. So there are no warning signs yet of a deeper correction. Of course, the support at the last lows is what we'd be watching. If we look at a daily chart of the NYSE Composite, yes, last week's action was pretty much what you were looking for. It was a pullback, a dip to buy, came down into the 20-day EMA on Wednesday, and then pushed higher towards the end of the week. So, R1 here, 22,165, R2 at 22,500, and if you see the AD line here, on the NYSE, it broke out to a new high, and as pulled back, it's holding its moving average. So clearly, if we were to break below these lows, it would not bode well for a Santa Claus rally. Sentiment numbers, the bullish percentage dropped a little bit, but the bull-bear ratio is still in an overall positive trend. There are 10% more bulls than bears. Of course, if we close strong into Wednesday, that number in this week's survey, which is normally lighter than most and therefore a little less reliable, could see a shift. Though the sentiment during the week was pretty negative at times with an increase in put buying, the AD ratios on all the averages were not that bad. You can see that, it was positive on Wednesday, Thursday, and Friday. The one negative day was about 40%. We're down on Tuesday. 1500, S&P 1500, shows a similar trend. And surprisingly, the NASDAQ 100 had a couple of strong days at the end of the week, up 36% of their stocks were higher. If we look at the weekly chart of the Qs, you can see that we're bumping into this R2 resistance here. Long tail, we had a low last week of 600 and change and closed at 617, so well off the lows. AD line here made a marginal new high, and RS flipped back above its moving average by the close on Friday. Looking at the daily, you can see we did make a new high on the daily AD line, and the RS daily has not turned positive, but it's still, holding this support line here. So a break below that would suggest Qs are no longer leading, and that's not what's suggested by the AD line action that said they're ready to lead higher, and that the big surprise next week could be in the growth stocks. Looking at the other daily AD lines, you can see, the SPY has been roughly in a trading range since the October high, around of up to 40 points. That would be pretty substantial. That would take in the market above, once we got above this high last week, that could push us up to, well above 700 with targets in the 718 to 20 area, which also corresponds to some weekly pivot points. So the AD numbers here, you can see the S&P 500 has broken out, and just holding here. So once again, it's well away from its moving average. If we saw a 2 or 3 to 1 down day early in the week, that could turn it negative. But more likely we might see some grinding higher, and that could push it to another new high. Stocks only, positive, but not as positive as the S&P. And same sort of thing for the NYSE. It's closer to its moving average. Typically when you get a breakout of a range in the AD lines like this, it is sustained by further gains. The NASDAQ Composite was up 1.3% on Friday, consistent with a rebound in growth. You can see the close here was pretty weak on Wednesday. New highs, new low analysis, still positive. Lower highs, lower peaks rather, in the new highs, this blue line, but no strong sell signal yet from the new lows. So you can see this 500 level. We got up to about plus 200 last week. So a strong surge above that would be bearish for the market. If you look at the NYSE Composite, it also shows, a trading range here. That's about 1,000 points. And on a breakout, that would put you towards that 22,900 area, or 4.3% above where we closed. Drilling down here, you can see that the trend for the NYSE 18 line, even though it's close to its moving average, is still positive. New high, new low analysis, New York Composite, also positive. We got right back up, so it's not showing the same divergence as there is in the NASDAQ Composite. 106 on Friday, not just 38 near new lows, so that's still a positive margin. Right around 200 is the number to watch. You see a spike above 200 new lows. That should be an early warning of a deeper correction. On Wednesday's sharp drop here, you can see this big bar down. Downside, I noted on Thursday's report, we got pretty close to the Stark bands, and so they were favoring a bounce. You can see the VIX move briefly above its moving average. Again, no clear signs of an uptrend like we'd seen earlier in the fall, but both reversed back to negative, so they're still in downtrends. Would expect them to start a new uptrend here in the first quarter of the new year, but no strong warnings at this stage. Looking at the growth value ratio, had a pretty sharp correction here down below its 20-week EMA. It was higher on Friday and for the week, so Was this a pullback in the overall uptrend? Given that the prior move was to the upside, that's got to have the weight of the evidence, as does the improvement in some of the RS. Still, I think the action over the next couple of weeks in terms of whether you're favoring growth or value, it'll be an important step to see whether we can regrain this, get back above 230, or whether we're just going to move sideways and start a new downtrend like we did in 22 when the growth stocks were hit hard and value was leading. The weekly MACD analysis is now more negative. You can see it formed a lower high in November. It's now well below the zero line, and these MACD and signal lines have crossed. So we'll have to see how a further correction is dealt, or whether the MACD histogram can rebound enough to get back to positive. If we take a little more detailed look at the SPY, you can see there's a trading range here of about 37 points wide. All right, up to this. So a strong close above that 687 plus level and an upside breakout would project a move to the 724 to 726 area. That would be pretty dramatic, and basically the AD line on the S&P has already broken out to the upside, suggesting that is the most likely scenario. Given the gains for the market this year, that could set off a scramble before the end of the year as money managers adjust to show they were more long during the year. And you can see the NYE AD line, even though it's a little narrowing in here, also broke out of that range. In terms of yield, before we go to the market watch, the 2-year note yield was lower, down 1.22%, so still below its 20-week EMA. MACDs are not impressive there. If we look at the, you can see they were also lower. MACDs are trying to cross on a weekly basis. No real divergences at that low. And if we go to the daily, you can see that it's really, we're still in a range. 4.201, 4.204. And after the decline we had into the September lows, lower lows in here, this is likely to be a continuation pattern, but you really won't, know that for sure unless you break back below that 4% and then the 3.988% level. If you drop below that, that probably will shake up the market, because that would be a significant move lower in yields. Let's look at the watch list. Pretty interesting. 71% ETFs are above their quarterly pivot, a good sign. You can see here that the RPG, that's the S&P 500 growth, now positive weekly and daily. Most of the growth measures in here are not. Two of the ones we currently like and hold are XLV and XLY. They're both positive. So that's a good sign, but really, there's a lot of room to move here. 30% with positive DTS. If we're going to see another run to the upside in growth, there's a lot of red here we'll have to contend with. If we look at the value, still 72% positive. And you can see some pretty, some deterioration. XOP, VDE, and XLE, all the energy markets, still, pretty negative. And, but the value, RPV, is positive, as is XLC, another one we like, and KRE. So if we're going to see a pullback further in value, I'll be looking at the financials. We're working on some projections for next year in terms of using the yearly pivots, and I'll be putting out a report to subscribers on what sectors one should look to accumulate in 2026. Down here we have, it's still the leverage short are still all green, okay, and the leverage long are all negative, okay. So, if growth is going to rebound here, we should start to see some of these flash back to green, and these will flash back to red. In terms of new weekly signals, pretty much sells in Brazil, i.e. another oil play, IYR, that's a real estate, and one positive, RPG, that's the Invesco S&P Pure Growth, both daily and weekly. We go back into the sector reports. GE, stock we got into last week. SPX, Starbucks also is looking better here. So there's a number of stocks that are looking like they have potential to participate, in a stronger market. So we're looking at that. Looking at the sectors, energy, 30%, still bearish. Lots of red in here, so I'm not willing to get back in there. We put out an article in July about comparing the XLE to the S&P, and it was not a pretty picture. And we found a couple of beaten down oil stocks in the last 3 months, so we've stuck our toe in the water, and I think it was attached to a live wire. So materials looking a bit better, 66.7. Okay, so Lin, CVA, DO, and as well as FCX. Of course, gold has been strong. Newmont, we're in on the growth stocks there, or in the stock charts system rather. Industrials, let's zoom this in a little bit here. 81%, that's one of the better readings. So, GE we already mentioned. Boeing also. So we're kind of looking like Caterpillar, maybe, Honeywell, and LMT could be stocks to look at next week. Consumer discretionary, we still like that. It's sort of a mixed bag here. You can see McDonald's and Starbucks and CMG, and so looks like there's a smattering. Lowe's is positive, but not Home Depot. So as I said, we're in the XLY, not the staples. It's sort of a mixed bag. 58% positive. Oh, let's go back to but the staples, the RS is looking more like a bottom here. So if the market is going to correct as we get into 2026, the staples could get some life. You can see the RS on XLY, the consumer discretionary, is positive, as is industrials, and not too bad on materials. Energy, lots of fake outs there, so I'm probably avoid that for a while. Healthcare, we think the correction was over a couple of weeks ago. And that's, a favored group as we move into 2026, as well as the biotech. You can see, there's a couple here that are red. United Health is kind of red across the board. Abbott just gave a daily buy, but 3-day and weekly have not. Financials, another one I like. It's sort of like traded between about 49 and about 55, but it's starting to act better technically. You can see all the banks are all green. Visa, MasterCard, BlackRock, Goldman Sachs, Morgan, they're all looking pretty good. 91%, have a positive 3 DTS. So, and it does look like a bottom in the RS pattern. Technology, well, what I've been talking about, the relative performance of growth is starting to emerge. So this will be watched next week. Are we going to get just a weak rebound in the RS, or is it going to start a new uptrend? Communications, lots of red here, 36.4, but overall the chart of the ETF does look pretty favorable. So Meta, 4-hour, and DTS, Disney, of course, Electronic Arts, and Google is, has a DTS negative, but the rest looks pretty positive. Utilities, I'm still in the XLY heading into the other because of the dividend, and but you can see there's not a lot of green on this chart. 16.7, and real estate 25, also something we haven't been in all year. This is the crude oil chart I wanted to show you before. You can see this is crude oil up here, got near the Stark bands, in early 22, and pretty much been in a solid downtrend below the 20-week EMA, and the RS also broke its uptrend in 22, and throughout this is a RS plot versus of crude oil versus the S&P, and shows that crude has been weaker than the S&P throughout this period. That's why one of the reasons we haven't taken much of a position. Will that change in the year ahead? It may. It doesn't usually stay down too long, though the dynamics and some of the cost of production issues and the demand are not very compelling. So as I mentioned, regular subscribers will get their watch list this afternoon. This Saturday afternoon, and we'll be publishing next weekend as well, and hopefully have another video. If you'd like to get on the list, to get the watch list, it's a pretty good read. If you want a copy of it, just email us at tom@viperreport.com. We'll send you this week's report, and you can see how valuable the information is for traders and investors. Hope you have a great holiday, and talk to you soon.